Hello and welcome. Today we're going to explore a fundamental aspect of the Philippine tax system, the value-added tax, or VAT. By the end of this video, you will be able to define VAT, differentiate between input tax and output tax, and understand how they are used to calculate your VAT payable. VAT is a form of indirect tax. This means it's not paid directly by the person who ultimately bears the cost. Instead, it's collected by businesses at each stage of the supply chain and then remitted to the government. In the Philippines, VAT is imposed on the sale, barter, exchange, or lease of goods, properties, and services, including digital services. It also applies to the importation of goods. The Philippine VAT system is governed by Title 1V of the National Internal Revenue Code, or NIRC, as amended by laws like the Train Law and the Ease of Paying Taxes Act. At its core, VAT is a consumption-based, creditable, and multi-stage tax. These characteristics are best understood by looking at its two main components, output tax and input tax. Let's start with the first core concept, output tax. Output tax is the VAT that a VAT-registered seller collects from their customers on the taxable sales of goods or services they provide. Think of it as the tax you, as a business, are required to charge your customers. It's a liability you owe to the Bureau of Internal Revenue, or BIR. The standard VAT rate in the Philippines is 12%. This means that for every 100 pesos of taxable sales, you must collect 12 pesos in VAT. It's crucial that this 12% VAT is shown separately on the VAT invoice or official receipt you issue to your customer. This transparency is a key part of the VAT system. Let's look at a simple example. Imagine a VAT-registered business sells goods to a customer for 100,000 pesos. To calculate the output tax, we multiply the sales amount by the 12% VAT rate. So 100,000 pesos times 12% gives us an output tax of 12,000 pesos. The total amount the customer pays is the sales price plus the output tax, which is 112,000 pesos. The 12,000 pesos is the output tax. It's the tax the business collected on behalf of the government. The legal basis for output tax can be found in the NIRC. Section 106 covers the sale of goods, Section 108 covers the sale of services, and Section 107 covers the importation of goods. Now, let's move to the second core concept, input tax. Input tax is the VAT that a VAT-registered buyer pays on the purchases of goods, services, or imports that are used in their business. So, if output tax is the tax you collect, input tax is the tax you pay to your suppliers. It's the VAT embedded in the cost of your business expenses. The most important characteristic of input tax is that it is creditable against your output tax. This means you can subtract the input tax you've paid from the output tax you've collected. This crediting mechanism is what prevents the tax from being applied multiple times as a product moves through the supply chain. It ensures that only the value added at each stage is taxed. Just like output tax, input tax must be supported by proper documentation, specifically VAT-compliant invoices from your suppliers. Let's use an example to illustrate. Suppose the same business from our previous example buys supplies for its operations worth 50,000 pesos. The supplier, being VAT registered, will charge 12% VAT on this purchase. The input tax paid by our business is 50,000 pesos times 12%, which equals 6,000 pesos. This 6,000 pesos is the input tax that the business can now credit against its output tax liability. The legal basis for input tax and its crediting can be found in Section 110 of the NIRC, which deals with tax credits. Now that we understand output tax and input tax, we can put them together to calculate the most important figure, the VAT payable. The formula for VAT payable is straightforward, output tax minus input tax. This formula determines how much VAT you need to remit to the BIR for a given period, usually a quarter. Let's combine our previous examples to see how this works. In our scenario, the business collected 12,000 pesos in output tax from its sales and paid 6,000 pesos in input tax on its purchases. Using the formula, the VAT payable is 12,000 pesos minus 6,000 pesos, which equals 6,000 pesos. This is the amount the business must pay to the BIR. This 6,000 pesos represents the 12% tax on the value added by the business. The business added 50,000 pesos in value, 100,000 sales minus 50,000 purchases, and 12% of 50,000 is exactly 6,000 pesos. What happens if input tax is greater than output tax? If your input tax exceeds your output tax, you have an excess. This excess input tax can be carried forward to offset your output tax in the next quarter. In certain cases, like for zero-rated sales, you might be able to apply for a refund. Beyond the standard creditable input tax, there are a few other types of input tax you should be aware of. First, there's transitional input tax. When a business registers for VAT, it can claim a transitional input tax of 2% of the value of its beginning inventory, or the actual VAT paid on that inventory, whichever is higher. This helps ease the transition into the VAT system by providing a credit for the VAT already embedded in the inventory. Next is presumptive input tax. This is a 4% input tax credit allowed to certain processors and manufacturers of agricultural products, even if they don't have actual VAT invoices for their agricultural inputs. This is a special provision to support these specific industries. Finally, there's input tax on capital goods. For large purchases of capital goods, like machinery, with a cost exceeding 1 million pesos, the input tax was previously spread over 60 months. However, this provision was repealed by the train law, and now the input tax on capital goods is fully creditable in the quarter of purchase. Many businesses engage in both VAT-able and non-VAT-able activities. This raises a question. How do you attribute input tax in such cases? The NIRC provides attribution rules to handle this. The goal is to ensure that input tax is only credited against output tax from VAT-able sales. First, we have direct attribution. If you can directly link an input tax to a specific VAT-able sale, that input tax is fully creditable. For example, the VAT paid on raw materials used to produce a VAT-able product. Second, for input tax that cannot be directly attributed to either VAT-able or non-VAT-able sales, we use ratable allocation. This input tax is prorated based on the ratio of VAT-able sales to total sales. For example, if 70% of your total sales are VAT-able, then 70% of your unallocated input tax can be credited. This ensures fairness and compliance. Let's briefly discuss refunds and carryovers of excess input tax. As we mentioned, if your input tax exceeds your output tax, you have an excess. This excess can generally be carried forward to offset your output tax in future quarters. However, there's a special case for refunds. Input tax related to zero-rated sales, such as exports, can be refunded. This is because zero-rated sales have an output tax of 0%, so there's no output tax to credit the input tax against. The law sets a time limit for filing refund claims. You must file your claim within 2 years from the close of the taxable quarter when the zero-rated sales were made. This 2-year period has been a subject of much discussion and case law. For instance, the Supreme Court case of CIR versus San Roque Power Corp. Clarified the reckoning period for these claims. Another important case, CIR versus Procter & Gamble Asia Private Limited, highlighted the need for proper documentation and client status in zero-rated claims. More recently, a KPMG case review in 2025 reaffirmed that input tax need not be directly attributable to zero-rated sales for refund purposes, which is a significant clarification. Finally, let's touch on the essential compliance requirements for VAT-registered businesses. First and foremost is the VAT invoice. As we've discussed, it must clearly show the VAT separately and include the seller's taxpayer identification number, or TIN, and the buyer's details. Second, businesses are required to maintain subsidiary journals for sales and purchases. These journals provide a detailed record of all VAT-able transactions. Third, businesses must file VAT returns. This is done using BIR Form 2550M for monthly declarations and BIR Form 2550Q for quarterly returns. These forms summarize your output tax, input tax, and the resulting VAT payable. Proper documentation, invoicing, and attribution are not just legal requirements. They are essential for compliance and for ensuring you can claim all eligible input tax credits and refunds. Let's quickly summarize what we've learned today. We've seen that output tax is the VAT you collect from your customers, while input tax is the VAT you pay to your suppliers. The VAT payable is simply the difference between the two. The VAT system, through this crediting mechanism, avoids cascading taxation and ensures that only the value added at each stage of the supply chain is taxed. We also discuss different types of input tax, attribution rules for mixed activities, and the process for refunds and carryovers. Understanding these core concepts is the backbone of navigating the Philippine VAT system. Thank you for watching.